Greetings, Russ McKee here with our next week for Seminar Saturdays. And this week's paper is about ETFs and dividends. This week's paper is called The ETF Tax Advantage and Firm Payout Policy by Ki-Soon Choi, Xintong Li, Benjamin Yost, and Yuan. My apologies, I'm sure I mangled at least one person's name there. And this was presented at AFA in 2026. This was a session that I was able to attend, and this is actually a corporate finance paper shoved into a session with 3 asset pricing papers. This was the 4th paper, so I had got to sit through 3 papers I didn't really want to watch, and ended it on the paper I was actually there for. It was quite interesting. So ETFs, as a quick refresher of what they are increasingly a common way to obtain a diversified asset. They're called exchange traded funds, and they are kind of a substitute for mutual funds. They're pretty substantial, like 30% of all of our equity trading volume is coming from ETFs as opposed to, say, individual stocks. However, despite them being very similar to mutual funds in giving people an easy way to diversify and buy a large diversified portfolio when you just buy a single ticker symbol, they have a difference with mutual funds, and there's a tax advantage for them. It's a little complicated, but I'm going to try to walk through this. So the ETF tax advantage is that when a mutual fund, as opposed to ETF, has to rebalance their portfolio, or an investor redeems a lot of shares, either way, the mutual fund has to sell some of its equity, because mutual funds are invested in and then they go out and buy stuff. They have to sell some of that stuff. And if there was any capital gains, they incur a capital gain tax. That tax passes through to all the investors who are owners in the mutual fund. However, because of the way ETFs are structured, ETFs don't have to sell when a rebalancing happens or if someone redeems shares. Because what happens instead is that the authorized participant, a couple of institutional investors, do an in-kind transaction with the ETF. So they say, oh, you need to liquidate some ETF shares. Sure, we'll trade those ETF shares for the underlying shares of stock. And an in-kind transaction doesn't trigger taxable income. ETFs can also even kind of exploit this further. They're called heartbeat trades because the trades are very kind of look like a heartbeat. There's a lot of wiggling going on with the with the transaction to eliminate some capital gains tax too. And the way that works is the authorized participant creates new ETF shares, and they deposit shares of the underlying asset with the ETF, and then they turn around and immediately redeem their shares. So they get the underlying asset right back, but the ETF doesn't give them the shares that they just received. They give them older shares that have accrued capital gains. And so those capital gains get washed out, and you don't have capital gains anymore. So there's fewer taxes. Now, this tax advantage is all about capital gains. You can avoid some capital gains tax in the side ETF, and you can't do it with mutual funds, but nothing changes with dividend. If a dividend is paid, you pay the tax whether it's an ETF or a mutual fund. There's no tax advantage based on structure here. So, as I teach my students when I talk about payout policy, one of the ways that the company is trying to decide how to return cash to shareholders, generally it's dividends versus share repurchases, is going to be based on the taxes for the shareholders. If the shareholders are being taxed differently, they're going to prefer one method of receiving the cash versus another. So if you're an ETF investor, you would prefer share repurchases, things that create capital gains, over dividends because you have a lower tax burden when that happens. Dividends, it doesn't matter to you. So do firms with high ETF ownership shift payout policy to better serve their investors? That's our question. So the data for this paper is not anything super exciting or unusual. They have FactSet for ETF ownership, and they have ETF daily flows to identify those heartbeat trades. And they also use CRISP for stock price information and dividends. Pretty standard databases in a finance paper. And they have an empirical setting like most papers will need to have. The problem is that investors are choosing ETFs versus mutual funds. And so if you have a lot of ETF ownership in a company, maybe they chose this company because it already had lower dividends, and the lower dividends are not being caused by ETF ownership. There are endogeneity concerns like always. We don't know that the ETFs are causing dividends. So what they are going to do is look at in one setting using Vanguard. Vanguard is originally quite famous for its mutual funds, index mutual funds. But there is a patent, apparently, that allows Vanguard to convert mutual funds into an ETF, or sort of an ETF. But the main purpose here is it gains the capital gains tax advantage when it does this conversion. So if a mutual fund converts to quasi ETF, all of those mutual fund shares suddenly gain that capital gains advantage. And it's effectively a sudden increase in ETF ownership for companies that are owned by that particular index fund. And there was a year when Vanguard converted a bunch of its mutual funds, and so that's going to be their setting. It's quite an interesting setting, actually. The discussant liked the setting too. So the first thing to look at is total dividends, and they find that there's a negative correlation between ETFs and dividends. Not particularly surprising, but it could just be that ETFs are selecting companies that are already low dividend companies. So we're not really seeing ETFs causing a change in payout policy. That's what we want to find. Before they run the Vanguard experiment, the authors are doing some subsample tests. So for instance, if an ETF is detected doing heartbeat trades, it's trying to take advantage of its structure to avoid capital gain tax. Probably there's a stronger incentive for the companies to shift towards share purchases because this ETF clearly cares about the tax advantage. If the ETF is mostly owned by investors that are more sensitive to taxes, we would think a stronger incentive too. So for instance, if I have an ETF but it's in my IRA, I have a tax advantage account. I don't care about capital gains versus dividends. I'm not paying those taxes either way. So if we know most of the investors are exposed to taxes, then that ETF should care more than other ETFs. And so they look at heartbeat trades here. So there's a lower dividend when there's heartbeat trades, and there's nothing going on when there's no heartbeat trades, which is pretty, the difference here is quite stark. It's surprising. So again, this is not causal evidence. We're not being forced to do heartbeat trades here, but it's quite suggestive. And they also look at tax sensitivity. So if you are tax sensitive, they're doing more. It's it's a larger negative effect here. The magnitude's much higher, and they do nicely show the p-value here, the difference between the two, and these are very small p-values, especially in their initial model. It gets a bit weaker when they go to the other one. And it's always good to see this kind of thing here because otherwise it's hard to tell if there's a statistical difference or if it just, looks different. They do show that dividends are going down, but the obvious question here is what about share repurchases? Because the logic of what they're doing is saying that we have tax efficiency. That means when we decide to return cash, we're going to return cash in the form of share repurchase and not dividends. But the amount returned wouldn't really be affected. there might be like a second order effect on how much you decide to return because the shareholders get more of what we're returning. So the trade-off of reinvesting versus returning might change a little bit, but we definitely should see a dividend reduction and also a share repurchase increase. Well, it's not nearly as strong for them. So they do find that share repurchases are higher, but if they have a stricter um, fixed effects, firm fixed effects, company fixed effects, it kind of goes away. They also do something with a two-stage regression using a previous dividend. I'm not quite sure about how to explain the logic for that, but thankfully it's a very weak result, and I don't bother to show it here because it doesn't really matter. Okay, so those are some correlations. Let's see the actual causality. And they're going to look at both dividends and repurchases. So with this Vanguard experiment, the Vanguard variable here is your Vanguard mutual fund that gets getting converted. Post is this is after you converted and became an ETF, or at least had ETF tax advantage. Total dividends didn't change. No evidence that they are changing dividends following this. Now, to be honest, it would be kind of surprising for them to find anything because firms tend to be pretty slow to change their dividend, especially reducing your dividend. Increasing at a lower rate, yeah, but even that might take a while to show up. They do find some potential evidence that special dividends, which are much more discretionary for companies, are going down for the Vanguard post period. But now they have really great results for share repurchases. Share repurchases go up a lot. It's very strong in this Vanguard experiment. So in the previous results, they had a lot of correlations that showed, yeah, dividends going down. And now they're showing in this natural experiment, oh, repurchases are going up. And it's kind of unfortunate for them. Like they have both pieces of the puzzle, but they're in separate places. One place here with the causal empirical setting, one place out there kind of overall sample. And you'd really like to see both at the same time to really make this paper work beautifully together. Okay, so how is ETF ownership translating into individual firms changing payout policy? So we think payout policy is changing. How is the ETF actually telling the firm, hey, you should change your payout policy, or is the firm just spontaneously doing it? So one thing to look at is shareholder voting. This is a way for investors to express displeasure at stuff the company is doing. And ETF is more likely to vote against management when they raise dividends or when dividends are higher. But we're not in causality anymore, so again, it's a little unclear. If a company has changed dividends or started dividends, again, stronger opposition, especially if you initiate dividends. But again, initiating dividends is a choice, and this is not the empirical. This is not causal. Authors have a second setting where there's an anticipated increase in dividend tax rate. This results in a large number of special dividends, but ETFs wouldn't care about the timing of special dividends, and they run some tests on that. And they do some tests about ETF inflows and outflows after the dividend payments. And this is something that discussed and suggested, which is, causality is kind of important. If you're doing research in finance and economics, you have to get causality. It's just a constant, overwhelming. The referees are going to just be on your case a ton about causality. So they really should be putting the Vanguard setting and maybe the dividend tax increase setting as the primary results. Like this is the most important thing. And the discussant, he was very interested in the Vanguard setting. I kind of agree with him. The Vanguard setting seemed like a really cool setting for them, and then worked. I mean, they had great change in share repurchases instead of with dividends, but like they were showing stuff with share repurchases. Okay, so that is this paper. There are different tax treatments for ETFs and mutual funds, which seems like it should result in a change in corporate policy. Unfortunately for them, the authors are able to find both pieces that would be consistent with this idea. We have lower dividends, we have higher share purchases, but they find them separately. They don't find them both at once, which is, as I said before, that's probably the very best scenario for them. But even just finding more share purchases is interesting. And this is a great example of how tax and treatment might affect corporate payouts, which, hey, we teach this in our intro classes. I teach this in my intro classes. This semester, I'll be teaching it. And it's really nice to actually see this kind of idea having research being done on it. All right, so that is everything for this week's paper. A relatively short one, but a very interesting one. And despite being a little bit about asset pricing, it's also a nice corporate finance one. So I hope you enjoyed our discussion about taxes. If you did, please comment, like, and/or subscribe so that others can find this video too. And I'll see you all next week.